So in this video, I want to go through the two most important steps when it comes to a whole life insurance policy if your goal is to specifically maximize the cash value. I remember years ago, I was working at a firm where my role was to design high cash value life insurance policies for corporations. The firm that I worked at really specialized in executive benefit planning, had experience with bank-owned life insurance, also known as BOLI, and working with some very, very high net worth individuals and large corporations. Now, I was a back office guy, kind of an insurance nerd. I still am today, where I had a ton of fun designing policies, modeling them for maximum cash value. But what was really interesting is at that firm, whenever we would work with a potential client, or I should say the owner of the firm worked with the clients, I typically was not involved in the meetings. I would get the orders and design the policies. But anytime a potential client came to the company, there was so much conversation around setting that policy up properly, but what insurance company do I choose? And it went well beyond just what was projected. Because when it comes to whole life insurance, there's projections. It's referred to as an illustration that often look very good over a certain number of years. But a key difference between that firm and the firm I worked at before then, which was just planning for individuals, just everyday people like you and I, is at the individual planning firm, we would look at illustrations and say, hey, based on the company's current dividend rate, we can expect the performance to produce exactly what you're looking at, Mr. Client. Whereas with the corporate firm, working with the, call it 1%ers, it was a much different tone. Those policies had to be set up properly, and the illustration was somewhat thrown out the window, and we wanted actual results. Meaning when we engaged with a CFO at a large corporation, you had to have proof of performance. Has this company delivered before? Are they reputable? And we want to know that these products we're taking on our executives for our corporation are going to be here for the long haul and provide or produce the absolute greatest results. So in working at that firm for quite some time, I really learned what whole life insurance policies produced the absolute strongest cash value for the policyholder. And as I left that firm, really in working with individuals and companies, we work with corporations small and large today, but as I left that firm, really what I discovered quickly is individuals wanted the exact same thing, or they want the same thing. There's so much interest around the topic of whole life insurance, but where people feel taken advantage of, or some use the term ripped off, or whole life insurance is a scam, is often when they are proposed or sold a whole life insurance policy under the impression that this is going to produce phenomenal results. Look at this dividend rate. It's got a 6% dividend interest rate. That's what you're earning on your money. It's not true. When they actually start to crunch the numbers, or a financial advisor does it for them, they say, here's the reality of the whole life insurance policy. They thought they had something great. Turns out they did not. They sigh. They come back to the agent. The agent gets very defensive. And there's a whole issue with whole life insurance because of this and many other reasons. But then again, you've got corporations who just pile boatloads of cash into these products. We work with corporations. Our largest client is a bank that has some very large high cash value life insurance policies. So it works. We've done several studies where we validated the proof of performance. But why? Why is there always such a difference? Well, we've got several videos that go into detail on that. Today, we're going to go through the two most important things you can do with your policy to make sure that it is set up for maximum cash value, just like corporations do, because you can have the same thing. The first thing to do, company selection. So you do not need me or anyone to tell you that there's a lot of life insurance companies out there. We can turn on the TV or YouTube for 15 minutes and advertisements will hit us all day long. When it comes to maximum cash value life insurance policies, the companies that have consistently delivered the strongest actual cash values to their policyholders are as follows, in no particular order: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Now, all of these companies have pros and cons. If you were to speak with any one of these companies, of course, they're going to tell you the best. And if there was any company that was just clearly the best, we would let you know and we would heavily recommend them. However, what I have found through actual data, through a performance study, policies dating from 1975 through 2021, and we ran this study, I ran it, with these 4 companies and smaller carriers as well, the evidence is so clear that when an individual is interested in a maximum cash value life insurance policy, these 4 companies have delivered. Historically, based on that performance study, we've seen internal rates of return, or I should rephrase, those policies have produced internal rates of return between 5 to 7%. Now that'd be great if it was still doing that today. However, to properly set expectations, if you were to take out a policy today, or if you've taken out a policy recently that was designed for maximum cash value, I'd set expectations somewhere between the 3 to 5% net internal rate of return, the actual growth rate on your cash value. So, first and foremost, company selection. We, IBC Global, primarily use MassMutual and Guardian. Sometimes we do show New York Life as well, but Mass and Guardian provide that quality any of the big 4 do, and you can also have a policy that's very flexible. Meaning you can adjust payments as the years pass, you can fund it for a short period of time, you can be very creative with the design, and you can with the other 2 carriers as well. So the first most important thing to do, company selection. The second thing, policy design. Now this piece can sometimes become or sound technical because when you think of an insurance policy, what comes to mind? I pay a premium, and if it's a life insurance policy, when I die, something bad happens, a benefit is paid out. However, with a whole life insurance policy, this next piece blows so many people's minds. I'm always fascinated by it, no matter how many times I talk about it and doing it. I've been doing this for 10 and a half years now, is when you pay any amount of money into a policy, you, the policyholder, can actually decide where that money goes. At the end of the day, your money can go toward one of 2 areas. You can direct it toward the premium, which I like to refer to as the initial insurance expense. Dollars that you direct toward the premium, whatever that dollar amount is. If it's $1,000, $10,000, $100,000, with respect to your cash value, typically 0 shows up in cash in the first year, and sometimes the first and second year. This depends on the company and product selected. Now, as time passes, you will see those premium dollars come back to cash value. So for example, I have a policy that shows 0 premium shows up in cash value in the first year. It's not uncommon to see by the time I hit year 2, those premium dollars come back to cash value. I can access it, begin to earn the guaranteed rate, dividends, and gets better and better. But what happens year 1? With the premium dollars, nothing shows up in cash value. Whereas with this guy, this PUA rider, which stands for Paid Up Additions rider, I like to refer to it as a cash dump-in. What happens with these dollars is as I pay them, guess where they show up? In cash value. That's money I can access, begins to earn the guaranteed rate, begins to earn dividends, and the growth accelerates on a life insurance policy. Now, it does purchase us some life insurance, but really, why individuals and corporations, the corporations we work with, why they plug in so much money into this area is for the cash value. That is the area of interest. Now, quick story on this. When I first learned about this, before working at the corporate benefit planning, the executive benefit planning firm, I remember one day I'm sitting on the couch modeling some policies, just kind of playing around with the software. My dad's sitting next to me, and it kind of piqued his interest when he saw the cash value build up. He's always been into investing, real estate, business. So he's asking some questions, and to make a long story short, he sees these 2 areas and he goes, can I just pay nothing into the premium because I don't care about the death benefit and put it all into this area to grow the cash value? And I'm like, no, you can't do that. He goes, oh, I don't want it then. Now, eventually, he did take out a policy many years later, but he demonstrated a common theme that so many people have. I don't care about the death benefit. How do I maximize the cash value? We often hear that initially, and then the death benefit does become valuable later, but at the same time, the interest is the cash value. So, how low can we go with the premium? Depends on the insurance company. Typically, we can drive the premium with these carriers. Some smaller companies let you go lower than this. Typically, we can drive that premium down to 10%. This 10/90 split. So what that means is instead of me saying, here's a $1 million policy, it's going to cost you X amount of dollars. Throw that approach out the window. Instead, I like to ask, how much do you want the ability to add into a policy on any given year? With the cash value being a safe, liquid, tax-free area to position money. Those are the core benefits of a policy, the cash value specifically. Safe, liquid, tax-free. How much do you want the ability to add into a policy on any given year? If someone says, I want the ability, Steve, to pay in up to $100,000 per year, what we would do is set that premium at $10,000. That is all they are committed to each year. And then they can throw in an additional $90,000 into PUAs. And they don't have to. Some years they might add another 10, some years another 50, some years they'll max fund it. My point is, the more money that goes toward the PUA rider, or the more the aggressive the split is, the greater the cash value. So really, to summarize this, I have limits I need to be aware of that the insurance company sets. All companies have different limits. It's not a clean 10x with each of these carriers, but it's very close. So this 10/90 means if I want to be able to pay in $100,000 per year, I would need at least a $10,000 minimum premium, and then I could pay up to $100K per year. If I wanted to pay a maximum of $50,000 per year, then I would need a $5,000 minimum premium, and I could pay up to $50K per year. So that's the insurance company limitations. And then next, I have this guy, this MEC limit, which stands for Modified Endowment Contract. So again, the core benefits of a cash value life insurance policy are safe, liquid, tax-free. Those are the core benefits. Any life insurance policy can become classified as this MEC, which stands for Modified Endowment Contract. If it does, what happens is that the cash value still grows tax deferred, but anything I access, I have to pay ordinary income tax only on the gains, and also a 10% penalty if I touch it prior to age 59 and a half. That is only if your life insurance policy becomes classified as a modified endowment contract. So we don't want that because it strips the policy of one of the most attractive benefits, being the tax-free aspect. So how do we prevent it? Well, every policy has what is called a MEC limit. That limit is exactly what it sounds like. It's the maximum amount of money one can pay into a policy per year and still have the life insurance policy classified as life insurance in the eyes of the IRS, not a taxable investment. The fun part is we can set that MEC limit wherever we want. And what you'll find is that it has a direct relationship to an individual's age and total death benefit. That is actually the measuring stick that the IRS uses to determine if a life insurance policy will be viewed as life insurance in their eyes, or a pure modified endowment contract, or if I want to access the cash value, I have to deal with potential taxes. So to summarize this, what are the two most important steps with whole life insurance to actually copy what the wealthy do, what the banks do, what major corporations do? How do I copy that as close as possible? Company selection and then policy design. Companies that have consistently delivered strong actual cash values to their policyholders, and then policy design. How do I minimize that insurance premium as low as I legally can per both the insurance company limitations and also the IRS limitations. If I do that, I will see maximum cash value from day one based on a guaranteed cash value basis, also a non-guaranteed basis, but the most important thing is the actual performance. The proof is in the pudding. I love that saying. So what to look for, because I know this can be overwhelming. Number one, with the policy in the first year, whatever my payment is, I should typically see between 80 and 90% of that in cash value. So if you pay in $10,000, I should see between $8,000 and $9,000. If I pay in $100,000, I should see between $80,000 and $90,000. Why there's a big range, 10%, depends on the company and product selection. Some companies offer more cash value up front with weaker long-term performance and vice versa. So that's where it's good to see options there. And then the break even, when I have more money in cash value than what I've paid into the product, should range between years 3 and 6. And again, this depends on the company and product selection. So I hope that you found this helpful. If you have any questions, please feel free to reach out anytime. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.